Okay, this is part 4 of the video. Part 5 of the video, excuse me. And this is the part in my class I hardly ever get to. And what I'm going to talk about is the cost of capital. And usually that seems to be just something you kind of throw away. And here's an example of some consultant who didn't spell the word academic exactly correctly. He said there seems to be a lot of academics asking how to compute CAPM. That answer is people don't waste their time on this. Nobody ever lost money because the WACC was measured wrong. Perhaps they didn't make good investments. Perhaps they undervalued a project or didn't or used too high a WACC. I believe they used too high a WACC. So, here's the problem, of course. In estimating the WACC, I took two different examples from exactly the same transaction. One had a size premium in it, the other one didn't. The same transaction. And there was actually incentive for these guys to use a low one because they were selling the company, and these guys to use a high one because they were buying the company. So it was even opposite. That's almost more surprising. They computed a levered beta, okay, a re-levered beta that we'll talk a lot about. And then this one computed an equity market risk premium of 6.6%. Enormous, enormous. And this one, we don't see what the equity risk premium is immediately. Maybe I'll have that a little bit later. This one computed a after-tax equity cost of 6.9. The after-tax equity was 10.8. Debt cost of 3.5. That cost actually a little bit higher in this case, and then you get to the weighted average cost of capital. And of course, I've shown this elsewhere. This is exactly the same transaction. They didn't even use. Did they use the WACC of 8? This one had 7.5 to 5.5. Their WACC was 5.9. So their WACC would be somewhere down around here, and they'd get a value. This one, the WACC was much higher. They used an exit multiple instead, and you can see the dramatic effect of the WACC. Okay, obviously, you can go to this thing called WACC Expert. It's almost a joke. I can't tell you this where they put this range of debt in, or you can go to Bloomberg and you get these crazy estimates. Okay, now uh, here's the definition. You should think about the definition. What's the minimum IRR you would accept on an investment that has the same risk? Okay. What's the minimum you take on a bond? A bond doesn't have no risk. You have a whole lot of inflation risk. If your bond has a nominal interest and not an interest rate where you index it for the rate of inflation. Okay. I think the equity cost of capital is the CAPM has been disproved for now years. I think Tassim Nicholas, right? Tassim had a quote that I've said that I think in another one of these videos that he said it's like a selling some magic medicine on the internet that's going to suddenly cure you. It's just a magic potion. That's where I get all of these things from. Now, I'm gonna without if you criticize the CAPM so much, you should come up with an alternative. Now, here's the other thing I'm gonna really criticize. They in almost all of these M&A transactions, you get a sample of similar companies. You get the leveraged beta. You take account of the net debt, and from that leveraged beta down here, you get the unlevered beta, and you take essentially the way they did it. They take the levered beta that you can get from either a source like Yahoo.finance or Value Line or something, and then you divide it by the debt plus the equity, and you should make a tax adjustment on the debt part of this. I'm not sure that they have the formula exactly correct. Okay, and then you can get the unlevered beta, Once you get the unlevered beta, you say, okay, well, that's the beta for the industry. Then you re-lever the beta. You take the unlevered beta and put in and I think I lost the thing, whatever. There should have been a capital structure here. You put in something like 32%. This should be the market cost of equity, not the book cost of equity. So the net debt might be the book kind of number on the balance sheet, but the equity relative to the debt should include the market to book or price to book ratio. You should increase it, and then you can get the here you get the 6.9 equity beta. And where is the market risk premium? Here was 5%. Again, I think that's extremely, 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 extremely high, but that's what people use. No real analysis. Here's another example. This time they did officially in the formula put this one they didn't put any debt beta. And what you really should do with these formulas, and I'm sorry, I made them too complicated. The beta on the assets is the beta on the equity times the equity percent divided by the total capital. Okay, and the where was I? The uh, this is the equity divided by the total capital, equity to capital. So the asset beta is the equity time divided by the equity to capital, and you put the debt at the net of tax, blah blah blah, and the debt is the debt. It should have the debt beta here. Excuse me, I should have put the debt beta here. I've got to fix that, shouldn't I? Okay. BD times the debt times 1 minus tax, and I better put the BD here. Okay, it should be just a weighted average where you account for the tax. Okay, this this analysis didn't account for debt beta. This officially did. But here's what you really need to do, and here's some more examples of I have an example of this. Who knows who I took here? I forgot even what industry this was. This was Caterpillar or somebody. And we took different equity betas and got an asset beta and did this without taking account of the leverage. Now, here is the gigantic problem. The debt beta is not insignificant. And where did I put this? Just a minute. I'm going to go through a couple of the other. Okay, I'm back. So I'm switching over to the website for a minute. If you understand that the interest rate on debt is some credit spread over and above the risk-free rate, once again, using a 10-year treasury has so much risk in it. It's kind of crazy, but we'll not even deal with the problems of measuring the risk-free rate right now. So we could express this formula as the risk-free rate, the debt beta times the equity market risk premium is equal to the credit spread. We could just rearrange the formula because RD minus RF equals credit spread. And then all we can do is say, well, okay, our debt beta is, we rearrange the thing, and our debt beta is the credit spread divided by the equity market risk premium. So if we know our credit spread is 2.5%, which is maybe like a single B, depending on what the market is, we could get a debt beta of 0.55, nowhere close to being zero. And here is the really big deal. When you have a higher debt to capital, when you put a debt to capital that's higher, the debt beta, the blah, 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 the debt beta maybe should be zero when it's really low, and then it gets really high, maybe not exactly zero. And then when it gets really high, you have a much higher debt beta because you have a higher credit spread. And you can draw out, you could try some sort of mechanical way to do this. You could do some kind of correlation of the credit spread against the debt to capital ratio. You could even try to do a simulated bond rating based on that. And I've addressed that elsewhere, but the key point is the debt beta is not zero, first of all, and secondly, it increases. And how many times have you ever seen this in the analysis? Because when you do this, here's what happens is the equity cost actually starts to go down as the here's the beta on the debt, and here's the cost of equity, and as the debt beta goes up, the cost of equity goes down simply because the asset beta stays the same, which is kind of right. That's Modigliani and Miller. And so that's the only thing I believe in finance, basically. And I don't believe it when it comes to project finance. And here's the graph. And you say, oh, we can't have a low cost of equity when the debt is really high. Well, of course you can. So here's I tried to write the formulas, and this should be done with taxes, not without taxes. So this is another example where I have where's the debt beta? I hope here's the debt beta going up and the equity beta going down, and you can put this all together with the taxes. But here's what you should remember. When you have debt is like a sold put option. If you have a regular put option, we get more money and we pay for that. So this is minus. We pay for that. That's a put option. We do better when the stock price goes down. Now, if you sell it, you do worse when the stock price goes down or the value goes down, and you get a positive number if the value is higher. That's like a credit spread and losing money on debt. Maybe you don't lose all the money, by the way, but the credit spread is pretty low compared to the amount you can lose. Okay, that's the payoff to debt. Now you can add to that the payoff to equity. So here's our payoff to debt, and here's the value of the company. Now, when this could be basically the value of the debt, you can adjust it, okay, for the premiums and all that stuff. But essentially, we have debt here, and if our value of our company, our enterprise value, falls below the value of debt, equity loses everything. But just pretend right here, you're sitting about here. You're sitting about here, rather. Sitting about here, and the value of the company right now is here, and it could go way down or way up. Well, the loss the equity takes is minimal because the debt takes the downside and the equity takes the upside. And when you think about this and when you translate this, that's exactly why the cost of equity actually goes down with higher gearing. It sounds like it doesn't make any sense, but it's totally logical. And that's the first thing. Now, the next thing is, what do we do about just measuring the cost of equity, just without all of our capital structure adjustments, which really could exist in the LBOs and so forth. So in an LBO, you really kind of have a nice little call option, and your required rate of return should be actually less if you really think about it. Okay, I don't want to go and tell that to private equity people. Okay, and then notice that I'm not doing any Excel on this other than showing you how the debt beta and all that works. Okay, so here's one thing we could do is we could take that PE ratio formula or that value driver formula, which again was rate of return. It was value equals E times. There should be a 1 minus, normally there would be a 1 minus G over ROE divided by K minus G, but we have to include all this inflation. And when we include all this inflation, we can back into what the the K is. And we can do we can compute this, and I didn't show it on the whatever, the website, but we could compute it up here, I think. Just a minute. Just a minute. The cost of equity. Okay, the cost of equity. We can just use this PE formula. Okay, and we can just put in our value driver formula, and I'm looking for, here's the value driver formula. Finally, we can put K equals 1 minus G divided by PE ratio. That's what you can do, but it gets a tiny bit more complicated when you include inflation, because the E is the next year's earnings, and we have to be a little bit careful with it, and that's where this formula corrects it. But this would be an alternative way. Now, instead of computing beta and the equity market risk premium, we would have some accurate estimates of G, and over the long run, we shouldn't assume a G that's much higher than the rate of inflation, or maybe the nominal growth rate in the economy. And we could do some sensitivities and see what kind of implied cost of equity we get. And this is a kind of an old-fashioned thing to do and an obvious thing to do, and nobody seems to do it anymore. And the real question is it more difficult to compute or estimate the equity market risk premium, which I think it is? Is it more difficult to try to figure out whether a long-term treasury has inflation risk, which I think it does? Is it more difficult to ignore, hopefully, um, all these absurd estimates of the uh, 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 beta that include mean reversion, that's from an article in the 1970s that nobody ever read? All of these things have problems, and if you really look at betas, they're not stable at all sometimes. Sometimes they are a little more stable. So that's one alternative. Another alternative is to use the fact you can rearrange the value driver equation and get the equation that ROE equals, I'm sorry, the price to the book value equals ROE minus G divided by K minus G. Now, if G is equal to 0, that formula boils down to ROE divided by K. And if you have a specific case where the price to book ratio is equal to 1, you get the fact that the K equals the ROE. That's standard. Now, if you have an industry where ROE is pretty stable, my argument is that you can go and get, this is insurance companies, you can go get this and then just make a regression analysis. And when you do the R squared is 85, it's pretty good. You can make the regression equation go through the mean or not go through the mean, and then you can look and see what's the ROE when, and even if you don't have any ROE market to books around 1, you can take that, but that should give you a pretty good indication of what the cost of capital is. So this is for insurance companies, and this cost of capital, I think, is pretty high. And that's pretty high. The stock prices were pretty low. Here's another one for utility companies, and it's hard. Sometimes you get an outlier that like this, and maybe we should get rid of this outlier and kind of see exactly what happens. And we don't exactly have, anybody has a market to book ratio of 1, and if we put zero intercept, we get a 4.88 or a 5.10 cost of equity capital. And I really, really believe that one. Okay, we could also rearrange this formula, which I didn't do. You could rearrange this formula and get that the K, you move this over here, K equals ROE divided by G divided by market to book ratio plus G. I should have, let me do that. Let's do one thing at least here. Let's make sure. So rearrange, and you get K, let's see if I do this right, equals ROE minus G okay, and we only have one k over there on the other side, divided by mb, but we had this k minus g, so we should have put k, this would be k plus k minus g over here, so we put plus g over here. So the other thing we could do, I'm going to save this file, and this is the file that will be uploaded for you. This one, along with, of course, all of our analysis. Okay, and this is going to be the last video in this piece, and I can't. Oh shit. Okay, where am I? Okay, and it's going to be the very, very last video in this piece. What you could do, I'm just thinking out loud. So what you could do is, if you knew everybody's ROE and had an estimate of everybody's growth rate, you could put in the ROE and the growth rate and the price to book ratio and rearrange and get the cost of equity capital. Okay, so you could either do a regression or try this, and I think you should have, again, not be afraid to throw out this crazy capital asset pricing model. This Nobel Prize winner named Eugene Fama says it's been obsolete for 25 years, and everybody uses it. 76% of respondents use the CAPM almost always or always, blah, blah, blah. No method comes close. The Fama and French model of 93, they don't use, well, they shouldn't. They should use one of these methods I tried to show you, because they're more realistic. And that was a really arrogant thing to say. And that's the end of this series. And again, remember, this series, if you don't like me, don't give me a goddamn thumbs down. I don't care about a thumbs up. But I'm just doing this for people in the class because they wanted a review. I'm not doing this. I'm happy to give it to everybody, but whatever. That's enough of the video. Goodbye.